Matthew Haraburda here, Chief Investment Officer at Bernardo Wealth Planning. Just wanted to reach out as we've just wrapped up the first quarter to give our review and reflection on the first quarter and our outlook for the remainder of this year. As a reminder, we came into the year with the phrase resetting expectations, as we did think that there was a higher probability for there to be volatility in the market given the overall valuation within the equity markets and also just the pure uncertainty surrounding trade policy. Uh, Definitely did not anticipate the speed at which we were getting kind of conflicting or different headlines every day, but clearly that upset the market and we saw a heightened volatility, not only in the equity markets, but also in the fixed income markets. So, as we think back to the first quarter, the market was really excited about a couple of things, primarily deregulation and tax reform. Uh, Clearly, the market shifted almost its entire intention only to trade policy because that's what's dominating headlines almost every day with regard to tariffs. All of this talk of tariffs and kind of the different degrees and the implementations of them have most economists talking about a potential stagflation, which is an area of higher interest rates or higher inflation, excuse me, and lower economic growth. And this makes sense, right? There's more uncertainty right now. So for consumers and business leaders to be making longer term decisions, they're probably going to delay some of those decisions until they have a clearer picture about what's going on, not only with their own business, but the underlying economy as well. So as we look forward toward the end of this year, what are the things that are on the top of our mind? One, it's the longer that this trade policy rhetoric continues, the higher the probability of it really starting to have an impact on the underlying economy, primarily for the reasons that we just spoke about. That is not our base case for right now. It is my belief that President Trump and the rest of his cabinet does understand that business leaders and companies and consumers need to have a clear picture in order to make rational decisions, and people have been putting off some of these decisions because of that. I think we might also see that there's going to be some quirkiness or lumpiness in a lot of the economic data. There might have been companies that actually front loaded their inventories or tried to get a lot of business done during Q4, which might lead to a slowdown in Q2. So when we think about everything that we have going on right now, how does that impact our portfolios and how we're allocating money? So as of right now, we continue to have a preference of value over growth, and we have a preference for large cap over small and mid cap within the equity markets. A lot of this is because we continue to believe that the larger capitalized companies have stronger balance sheets and are able to weather the uncertainty a little bit better than the small and mid caps. So while they do tend to have higher valuations, because of all these different levers that they're able to pull and they're better capitalized companies, we believe it's a more defensive spot to be. And then obviously owning lower valuation stocks than growth stocks during a time when there is a growth scare or there's uncertainty around growth, we think is prudent. And then on the fixed income side of things, we've started to favor more short duration bonds longer than long term. If there is a scare and there is going to be potentially higher inflation due to tariffs, we don't think that you're missing out on too much within the fixed income market if you're not extending out. So by owning shorter term bonds, we still think that you're getting a reasonable coupon and yield right now. And if we do see longer end yields start to trade up slightly, I think we might look to take advantage of that. So again, still optimistic for the longer term. Obviously, it's been a pretty bumpy Q1. We do think that it should subside later this year and that there should be more certainty. And once that happens, I think the market will shift its focus back to thinking about the deregulation and thinking about the tax reform. If you have any questions, please feel free to reach out to myself or your advisor and hope to talk to you soon. Thanks.